Hello and welcome to Fireside with a VC. My name is Andrew Romans, and I'm excited for this episode today with Nathan Beckord, who is the CEO and founder of Foundersuite. And today we're going to talk about fundraising. So everyone's favorite topic of the pleasant experience of getting out there and raising the first funding for your startup, and then the next amount of funding, and then the next amount of funding, and the next amount of funding. So Nathan, good to see you again. Welcome to the show.
Yeah, thanks for having me. Even though it might not be everyone's favorite topic, it's a topic I love to talk about. So I'm glad to be here with you.
That's great. And Nathan also has a podcast called How I Raised It. So he's got people, I think I understand, specifically telling stories about how they raised, angel and VC funding. That's right, isn't it?
Yeah. And thanks for the opening to plug it, but I won't go into too much, and I can't wait to get you on the show. But basically, this idea was, let's just get into the weeds with entrepreneurs, mostly startup entrepreneurs, but we've been starting to have venture capital firms on there, even a couple fund to funds. And let's just really get into the weeds of like how they raise capital for their startup fund to fund, whatever it is. And it's really tactical. I thought I knew everything about raising capital. I thought I was the expert. And then I get people on the show, and I've learned a ton from it. So if you're looking for real practical, tactical stuff and kind of inspiring stories, because some of these people have gone through, the ringer on their way to getting funded, it's pretty interesting.
And, so when I come on your show, I was going to tell my story about how I raised my first 5 million of funding and specific tactical things.
Yep.
But things are changing. So, my story is as true now as it was back in the mid 1990s, but there's a whole lot of things that are around, not least of which Foundersuite. Why don't we just start and just knock that out of the way? So I've known you for a long time, but it was only more recently that I started understanding what Foundersuite is and what it does. Maybe describe first, when did you start Foundersuite and what has it evolved into today?
Yeah. I'll give my very short history. I got out of college, went into investment banking during the dot-com boom, helping companies, go public, and then spent a little time in JP Morgan's private placement group, helping companies raise later stage rounds of funding, and then got kind of tired of that and took that playbook, came out to Silicon Valley, and spent about a decade helping early stage companies raising capital. I think that's where we first met. That was a firm called Venture Archetype. So, kind of acting as like fractional CFO or consultant to all these early stage startups raising capital. And then one day just had this idea. We would get a startup in the door. We'd help them build their pitch deck, help them build a financial model. We'd do the research, build a target investor list, put it all in this elegant spreadsheet, and then hand it off to the client. And, this was around the time Marc Andreessen came out with his software is eating the world statement, and kind of had this idea, like, why don't we build some software for this? So it really started, Foundersuite started as a little side project of the consulting business where we were, doing it on the side. And then it kind of got a little traction, little legs. So we spun it out into its own company like 5 or 6 years ago now, and have just been off to the races full time on this, building software tools to raise capital.
So how does it work? So if I've got so how early is too early to start working with Foundersuite?
I mean, frankly, I would say if we did a pie chart of our users, probably 50% are pre-seed and seed angel rounds. The rest are Series A, Series B, and even some other types of capital raise like real estate and things like that. But really, probably beyond that first check where your dad and your uncle and your aunt are funding you to the tune of 100K. Anytime you've got to go out and source investors, strangers, and really run a process, right? You talk a lot about running a process. That's where Foundersuite really comes into play. And so that is often, pre-seed through Series B and C.
Okay, so why don't we, and how does Foundersuite work? So I go to your website and then create an account and I start paying a certain fee, or how does it work? Are there free resources there?
There's a free version that's free forever, doesn't require a credit card. You can poke around. Doesn't have all the bells and whistles, but the next plans up are $69 a month. So it's pretty affordable for most startups. And basically you sign up, you get dropped into the account. And typically the first step would be to start building an investor list or target investor list, right? So a lot of people might have a spreadsheet they've already curated or collected, but we also have a database of about 200,000 investors to search from. You can go in and search by industry, type of investor, everything from angel VC, corporate VC, family office, even up to private equity. So, you typically would spend some quality time building a target list, doing the research, and loading all those investors into the CRM. And then the CRM is kind of your operational hub for the fundraise, where you're using it to track all the actions, tasks, follow-up things, tracking the email conversations with investors, stuff like that, right? And then the other tools are as you get a little further down the process. So we've got a pitch deck hosting tool, which is kind of like a DocSend Lite. We've got an investor update tool for doing, ongoing investor updates to both existing investors, if you've already raised some money, but also to prospective investors. That's something I really tout heavily. And then, email tools for doing follow-up. And then we just launched a data room to put all your confidential stuff in there. So when you're getting into due diligence with these investors, you've got a place where you can securely store and share your confidential stuff. And then last but not least, we have a collection of like downloadable pitch decks, term sheets, cap tables, things like that you can use. So if you kind of think about the entire fundraising journey from identifying the right investors through closing the round, we're trying to build tools for each step of the journey.
Okay, so right now I pay for DocSend.
Yep.
If I were to sign up and start paying for Foundersuite, I could cancel my DocSend account. Is that right?
Yeah, I mean, I hate to say it because I don't want to raise the wrath of too many firms out there, but yeah, basically we're replacing and consolidating 6 or 7 other products in here.
Yeah.
You could theoretically cancel your DocSend, your PitchBook, your HubSpot, your whatever email tool you're doing, and your data room, right? And then roll it all into one platform for $69 a month.
And what would I be paying for that if I were to get the full Monty there?
$69 a month. We have one other version that's called Agent Model that is used by investment bankers and some VCs. If you're actually going to be working with multiple portfolio companies, we have a version that's $150 a month, and then it's $50 for additional deals. But that basically lets you have multiple companies under one account. But if it's just your fund or your startup, it's $69 a month, and that includes multiple users, no extra charge. Just that's it.
Because I have a rule, or we have a rule at 7BC Venture Capital, that if we cannot add value to the company, then we should not be investing in the company.
Good
so
rule.
Like a checkbox is, what would our value add be that we could do? And one value add is, which is for anybody, is that we can help them raise capital for their next round. And so our business model is we raise money from LPs, we invest that money into startups, and we make our money from a management fee and the carried interest performance fee, like 2 and 20, right? We do not charge money for fundraising for the company, but this is we do free investment banking for every one of our companies. And so maybe we start jumping into the weeds on this. I mean, what we typically do is we make a Google spreadsheet. Yep. So we're not using your digitized fancy end-to-end, solution yet, but we just make a Google Doc where I typically list like around 100 VCs that I generally, list. And so there might be some CVCs on there, or just pure financial VCs. And we list the name of the fund, the name of the individual at that fund that we would target. And then we list who is the primary person to introduce the CEO to that individual. And so, you might say this person at that fund, and then we share that with all of the investors that are already in the deal with us. And so that would be the angel investors as well as other VCs. We're a real play nice with other kind of fund, as opposed to sharp elbow everybody out of the way. I must have my ownership percentage of
Yeah.
25%. And so trying to get rid of other people. We're the opposite of that. So we basically will then work on that list and say, I'll put my name, Andrew Romans, next to all of them, but say, does anybody have a better relationship with anybody here than I do? Like I know David Blumberg well, but I probably should be the one to introduce you to David Blumberg. But there's other ones where I'm like, I'm not so sure how much she loves me or likes me even. I know her, she knows me, but maybe someone else can make that introduction. And then after we do that and we have all of our docs lined up, then we go into solicitation. Maybe with why don't we just talk about advice for founders? So for founders, using Foundersuite or not, having done it professionally and then begin to digitize the whole thing and productize it, what's your advice to founders when they're moving past that friends and family that you described?
Yeah, boy, I've got a lot. I'll try and keep it short, but I always tell founders, like, fundraising is not rocket science. It's learnable, it's doable by anyone, but it has a lot of little nuances to it that can trip people up, right? And we see these, I'm sure you see these every day, people approaching you and stuff like that. I would say, advice number one, the two bits of advice that correlate to each other. Number one is spending the time actually doing the research, like digging in and researching and qualifying investors, making sure the people that end up on your target list, really do your sector, your stage, your geographic location, that they're ideally you've identified that they're actively investing. Maybe they raised a new fund, really spending the time researching and even just going into the qualitative stuff, like following them on social media or Twitter and getting a feel for, what they're talking about, what they're interested in. So I kind of liken the process to a sales process, right? Good salespeople qualify their leads heavily, prioritize their leads, spend a lot of time on that before making the sales pitch. And so I think that's something a lot of founders might skip a little bit. They want to just download all 10,000 SaaS investors in our database and start blasting them. And that's a mistake, right? So spending the time qualifying. And then the other big piece of advice, and this really has been like corroborated with the interviews that we've done on our podcast, is, start the relationship, initiate the relationship early, ideally even, 6 to 12 months before you actually want to raise money, so that investor can get to know you. They can see your progress a little bit. They can just see kind of, there's a Mark Suster quote, right? Investors invest in lines, not dots. They can start to see some data points on a metaphorical graph of how your business is shaping up and how you're making progress. So that's something a lot of founders don't do either, right? They say, I need to raise money in April. I'm going to just start pitching investors today, where really, if smart founders or even second time repeat founders kind of think about this way far in advance, start to build those relationships, nurture those relationships. That's one of the things, like I'm always telling our founders, use the investor update tool. Send out like a short 1-page update to these investors you're trying to, get to know and get them to know you. So those are two starting points.
And what should a founding team get in order before they go into solicitation? So you've got a target investor list that you can build like the way we do it or using Foundersuite. But before you go into solicitation, what are the ducks they need to get lined up, in order? You kind of mentioned like an Excel spread, your financials or.
Yep. Yeah. I mean, and it's funny because I had been fundraising for a while. And then when we were raising capital, I got a term sheet from FFVC, New York,
John Franco
fund. Great guys. Love them to death. And they got the term sheet. I was super excited. And that was on a Friday, I think. And then on Monday, they sent me the due diligence list, which was, I kid you not, it was like 120 items. It was massive. And I really wasn't prepared for it, to be totally honest. Like, it was a huge list. And so that's one thing I would definitely get in order first, all the due diligence stuff. And that means getting your corporate docs ready. These might be at your attorney, they might be who knows where, right? Getting your financials, building a financial, even a basic financial forecast. Um, getting any intellectual property all together, getting your product roadmap in some palatable format, getting things like customer references ready so that when investors want to check on this, you've I don't want to say you've groomed your references, but people know that investors are going to be calling you, right? Things like that. So, and we have a folder structure in our data room, which I haven't memorized, but basically if you kind of think about all the different sections of your business, it's like, what is an investor going to want to dig into? It's everything. So you kind of have to get all that stuff ready. Even things like, being ready to share your Google Analytics or things like that is really helpful. So those are some of the.
What do you recommend for a financial model? So I mean, historical and pro forma financials. What do you recommend most startups show there?
Hey, you're asking. I'm a little biased in this because I used to build financial models for startups for a living. So I probably, maybe go overboard. I think having a good listen, and tell me if you disagree with this, but I think every investor knows your financial forecasts are kind of BS or imaginary, but you want to be able to show investors that you've thought through what your business model can look like as it scales. You want to show you've been thoughtful in your costs, right? If you're raising $1 million, you should be able to articulate pretty carefully how you're going to spend that $1 million, whether it's on engineering salaries and you're going to hire X number of engineers over the next 6 months, 12 months. With the actual model itself, I usually will do like the first 2 years on a month by month basis. So I'm really granular. And then maybe the remaining 3 years, it's a little more of a formula type of thing that just shows what this could look like in 5 years. But being really granular, especially around the costs and then what the business model can look like at scale are the things I really drill on.
I like to see I like to see historical financials that show monthly. These are our revenues.
Yep.
I like to see revenue broken down by different types of revenue. You might have a company that has they're saying that they have MRR of 100K a month, but in reality, 50% of that was one-off development work that they've cleverly done for some of their customers, and only like the other half is the reoccurring SaaS revenue of the new product in maybe a pivot. And there might even be some like legacy revenue in there. And so I think it's useful to understand the revenue. And then I like to see monthly because it begins to show how chunky the revenue is coming in. Like, did you get a 12-month? Did you do a pilot that you got paid for 250K and then that converted to a 450K annual, but it was paid up front?
Yeah.
Or it was paid in these chunky payments. And so sometimes you can almost understand it quarterly or annually, but I like the ability to see it on what's happened in the past. And when you get into the pro formas, yes, it is uncertain what your sales pipeline will close at, but what is rather certain is how you are intending to spend the money that you're raising. And so like, I generally like to look at if revenue were flat and nothing comes in, we have a certainty of how these people plan on spending our check that we're going to wire them. How many months of runway do we have? In the worst case scenario of another variant slows down the ability to close anybody, and how many months runway have I got? And I kind of want to see a minimum of 18 months in a doomsday scenario where revenues were flat. And you can have your model roll into another tab that shows it quarterly and another tab that shows it annually.
Yep, exactly. I agree with all that. And I think I'm thinking of the models I've done. I haven't done one in a while, but thinking of models I've done, you have the monthly buildup, usually the revenue assumptions as inputs on one page. You have your cost assumptions possibly on another page. it rolls into monthly, quarterly, annual. So you can have an annual summary that you can then drop into the pitch deck, right? And then I would also add the tab for the unit economics, right? And this is the tab that's really showing whatever your unit economics are, whether it's, cost of acquisition, lifetime value, churn rates, things like that, right? Because that's the other thing I like to put in the actual deck, and I'd love to hear what you think. I like to put the annual forecast and then the unit economics table, and that's my financial slide in the deck typically.
I like that too. And I like when you're looking at CAC LTV unit economics, I also like to see payback period. So if you're spending $1,000 to acquire the customer, how many weeks or months does it take before you get your $1,000 paid back?
Sure.
So it's not just that like I spend $1,000 and I make 18,000 as the LTV. How quickly are you getting the $1,000 actually wired back to you from that?
A really good payback period. It's funny. I'm thinking of our own metrics now, and I haven't really calculated that, but I can do the quick math on that. I don't know. Do you have targets for like SaaS businesses you're looking at?
I mean, I'm more open-minded of, what are we dealing with? If we invested in Radius, where they've digitized everything for a real estate agent. So if you work for Century 21 and you were getting 30% of the value of every house you sell of the fee, and then someone else offers to give you 50% of the value, you're going to eventually quit your job at Century 21 and move over to Christie's and Sotheby's, who are giving you 50% because you're the best real estate agent in East Hampton, New York. And then someone else offers you 70%. You're like, all right, to hell with Christie's and Sotheby's, I'm moving there. So it's kind of a race to zero. These guys are like digitizing everything so that they can basically give everything to the real estate agent and just charge a fee. With them, if somebody sells like 2 houses in the first month, then they get their payback right away. If it's a really bad real estate agent that's not closing a lot of deals, they get it back within like 6 months. And I kind of think of it as a relatively rapid payback that we can really scale revenue quickly on, and gets me excited. If somebody else has got something that's a true marriage with venture capital, that they have an 18x CAC to LTV, but it takes a full 18 months to get there. I think there's a lot of companies in Silicon Valley that are in the business of selling a dollar for 50 cents.
Sure.
You know what I mean? So it's like, you see the company is like, 2 billion in revenue.
But we'll make it up in volume, right? That's the answer.
Like it's spent 4 billion to make the 2 billion. It's like, it's scary. If they spent 200K to make 100K, that doesn't scare me as much as that they're actually spent 2 billion to make 1 billion. That gets even scarier.
I think I remember during the first .com bubble, some of the stock analysts, I was doing some stock research at the time, and that was always the thing. It's like, okay, they're spending $1 billion to make 500 million, but they'll make it up on a volume eventually, kind of the thing. Or the argument was that if they keep spending at these levels, it will drive out their competitors, and then they'll be able to actually charge a profitable fee or whatever. There's all kinds of arguments. Startups.
I like to
delusional.
When you really get into a good financial model, you're getting deep into when will this company tip into profitability? Like, what does it take to tip this company into profitability? Like, and exactly where does that happen in the financial model? And if the investor's not engaging at that level, and if the CEO doesn't know it, like if the CEO says, oh, I'm really just the salesperson here, I don't even know my own business, you're probably not going to invest in that company. So financial model, we kind of covered that. What other docs? I mean, what's your advice on decks on the pitch deck?
I want to add one extra little thing that just came to me on models, and then let's move to decks. But the one tricky thing I think that can trip up founders, especially maybe non-financial founders sometimes, is I think there's this expectation investors need to see whatever it is, 100 million in 5 years or some, huge growth rate. And so you're building your model to match this like expectations of investors. And then, in reality, everything takes twice as long, costs twice as much to get there. And so your actual results aren't going to track that. So how do you manage that with your investors, knowing that in reality, you're not going to hit that 100 million in 3 years or 5 years, whatever. So anyway, just be cognizant of that you have to sort of manage that delicate tightrope of showing a sexy model, but knowing reality is going to be different than
Yeah,
the
I mean,
model.
so this is the hockey stick, pro forma that revenues are just gonna our revenues are gonna be bigger than Groupon and Cisco, which set world records of how fast their revenues grow. Why should I believe your revenues are gonna, not be normal, but be better than the biggest ever? And that can be a turnoff. So how do you think about, if revenues are zero now, what do you think is a realistic, 3-5 year top line revenue that's conservative enough to look realistic, but ambitious enough to make a venture return for an investor?
It's hard. I mean, it used to be the standard was 100 million in 5 years. That was sort of like what we made sure all models hit. Because if you're forecasting 20 million in 5 years, you're not going to get investors excited. If you're forecasting $1 billion in 5 years, that's probably not unrealistic, or that's probably unrealistic. And so we were always doing 100 million in 5 years. I don't know if that's changed. I mean, I think that would put that question back to you. It's like, things are faster now. You do see companies hitting that hockey stick growth rate at a faster pace than I think they used to. So I don't know if that expectation has changed, but I think somewhere that there still might be a North Star to aim for, because again, smaller than that, people aren't going to get excited. Way larger than that, they're going to think you're totally off your meds.
Yeah, I think so. There's two things. One is what is changing, and then the other one is what can the company be sold for, and what is the valuation now, and what kind of return are you offering investors if you believe you believe the numbers. So what's changed is that since COVID, the time delay between closing a financing round and the next financing round is shortening.
Yeah.
So you had kind of 18 to 24 month runways is the cash runway a company should be raising for, in my opinion. That if you raise for under 18 months, then you're not going to be able to focus on your business. You're going to be back out dealing with all of your lifelong investor target list and researching and all that, as opposed to just building things and talking to customers, right? So so what that meant is that if you have an 18-month runway, if you have more than a 24-month runway, you may have sold too much of your stock at today's cheap price. And you should probably only have the 24-month runway so that you make progress in these coming months to the point that you can raise money at a higher valuation because of the growing revenue, if nothing else. So that's kind of like why you wouldn't typically have more than a 24-month runway. It happens to companies that they didn't necessarily need to raise money and investors were finding them. And so they find themselves with more than an 18-month runway, which does happen. And they just agreed to sell the stock at today's cheap price, But if you have an 18-month runway and you don't want to close funding with 2 weeks cash for payroll, right? So that means that you probably want to close your funding round when you still have a comfortable bank balance that would carry you another 6 months. So what that really means is that if you raise money on, March 1st, you probably want to raise money on March 1st of next year with 6 months cash in the bank if you were on an 18-month runway. Now some of that hockey stick stuff might be happening and your runway is extended, but we plan on flat, which is maybe irrational, but we do. We plan on flat, and what tends to happen is that the founder starts spending more now that they have more revenue coming in. So the burn rate remains constant. So if you were burning $1 million a month and then more revenue comes in, then you're spending more, but you're still burning $1 million to have that timeline. So it meant that in the old world, you would raise every 12 months. In the new world, we're seeing a company raise capital, we announce it, and immediately VCs contact me asking to be introduced to the company. And I go along and I make those introductions. And the company is raising money almost immediately. Like we invested in Quant AI, and then JCal came in with Launch Fund and invested like 2 weeks later. And because the share price is now much higher, that my fund is up almost immediately on that investment, which is not the way the world kind of used to work. So we're seeing companies raise a bit faster. It's a difference. But the other thing is, if a founder, like a mistake would be a founder makes a financial forecast that is so conservative that they're only making like 10 million of revenue in 3 or 5 years. And yet their valuation today is hot and spicy, meaning it's high. And if those projections were accurate, and we say we could maybe sell the company for 12x revenue at best, but potentially 8x revenue, you're saying I could sell the company for $80 million and you've got a pre-money valuation of 60 million today. How is that going to put my fund to do as well as my last fund, which was 15x? You're going to be dragging my fund down with that investment. So I think founders should try to backdoor their way into today's valuation with tomorrow's ultimate investment. And maybe the VC should be prepared for 50% dilution. So when you see these 100 million pre-money valuation and a $1 billion exit, that sounds like a 10x return, but it's not. It's like a 5x return if they raise a lot of money between now and that exit. And a 5x return would be dragging down my fund, So that's just something to think about.
Absolutely. There's a lot to this, and I won't make this a sales plug, but we do have in our docs collection a dilution scenario analyzer that's kind of fun because you can go in and plug in different funding amounts and timing, and you can see what everyone's ownership percentages do, and then assuming a certain exit, what that means, right? It's just a good exercise because this stuff is complicated. This stuff is not, totally intuitive for founders all the time, how the economics work for themselves and ventures.
I'm really curious to see that because I've got my own sheet that I've made for my own portfolio companies. I use it with my students. I call it the journey of the entrepreneur, the journey of the founder. And it starts with 2 people, 50-50.
Yeah.
With that sheet, actually, the wisdom that I've seen from this Excel spreadsheet that I've made is don't worry so much about dilution. Founders are just obsessed with dilution. And in the end, of my entrepreneur journey, I'm like, so now let's look at the exit scenarios of what it sells for. And it sums up every funding round that you've raised in this theoretical thing. So it shows the liquidation stack. And if you take a 1x liquidation stack out of it, and your ownership is this, and your exit was either A, B, C, or D, this is how much you made. And you can kind of think of that as divided by X number of years. Am I doing better than when I was doing private placements at JP Morgan? Maybe not.
Sure, right. I know.
It's like if it was 10 years of your life.
That's an exercise you don't want to do, because I've actually gone and followed some of the people I used to work with and who are now, managing partners and made partner at Goldman. I'm like, oh my God, even if Foundersuite does really well, those guys, like the path that they went on.
And then sadly, there's age. We're not vampires. I wish we were, but some of those guys are retiring.
Oh yeah, absolutely.
So that's another thing. Some of these guys are retiring, and we're somehow in this endless treadmill. So,
but I promise to you that you and I and the founders listening or you're working with are having more fun than the investment bankers. I promise you that.
I hope so. I mean, sometimes I say stop and smell the flowers when you're doing this strategy meeting, because this is it. Like the journey is the destination. You should be enjoying your whiteboarding strategy of who to bring in. So how about some other advice on early, like what do you have a policy on advisory shares? Like if a company wants to build a board of advisors where they're basically prepared to gift some equity and give some warrants away for somebody to bring some serious names into a business, have you kind of canonized your thinking around that?
Yes. And we have a template for that. It's an advisory board agreement with some like tables of different ownership amounts. And actually, I can't even take credit for it. I believe it was developed originally by Founder Institute, Adeo Resi and those guys. But it's a really good document. And, basically the way I think about it is, anywhere from a 10 basis points up to 1% is typically what you might be giving away to advisors, depending on their level of involvement. Are they going to be just on call for occasional strategy calls, or are they going to be like helping you recruit, senior talent or something, right? Kind of what are they going to be doing? How active are they going to be? How big are they, right? I mean, if these are name brand, really credible people that are going to increase your valuation because you brought them on board, then maybe they're worth, 0.5% instead of a quarter of a percent or something like that. And I think, if you're giving away like 1% to an advisor, they really better be name brand and involved, right? So you kind of think of the matrix of how much value can they provide and how active are they going to be involved, and then, kind of structure it like that. I mean, I've seen everywhere from 1% to 5% of the company carved off for advisors. Some industries need a lot more advisors than others. And depending on your expertise, if you're, just one scenario, you're fresh out of college, but you're doing some life science type of startup, you might need a really robust medical advisory, scientific advisory board, and you should be willing to carve off more equity for that. Just like you carve off equity for your employee option pool, I think it's, worthwhile to think about it as currency for advisors. So,
and do you have thoughts on vesting schedules with time or milestone based with advisors?
Yeah, that's a good question, because sometimes advisors become duds, right? They've got a great brand name, but they really aren't very available to help. The more you can make it milestone based, but then a lot of advisors don't want to have specific deliverables around that. So I do think a time, at least a vesting schedule, helps, because if they're really a dud and not doing anything, you can, cut them off and say recoup some of that equity. I mean, I've seen everything from 2 to 4 years. I've seen everything from 1 to 4 years, nothing really longer than that. Because a lot of that advisory help is probably going to be in the first year or two anyway.
That's the thing. I think that a founder, if you put founders on a vesting schedule, which I'm in favor of, to protect the company from somebody leaving and not working as hard as the other founder, that's more like 4 years. Vesting schedule is pretty normal. Whereas with these advisors, it's like, hey man, I don't need you in 4 years from now. Yeah. I need you to take me from nobody to knowing everybody today. I want you to open the doors right now, and then you can go to Hawaii like in 2 years from now. But I need you right now, or else I wouldn't be talking to you. So, you got to deliver for us within 24 months. So I think that the advisor vesting schedule, shouldn't be more than 3 years max.
Sure.
And it's potentially even 2 years. You might as well put it as 3, but that's kind of my thinking around that. And how about so people can just get their credit card out and get some exciting angels and early stage investors through Foundersuite. What's your policy around getting introduced?
Yeah, I mean, this is still a difficult part of the fundraising. I think one of the areas that's still messy and hard to do is the introduction side of things. We don't make the introductions. We're not in the broker business. We're not a registered broker dealer, so we're not doing that. In general, my thoughts on that are founders should, step one, go to their LinkedIn, plug every single investor into LinkedIn, see if they have any mutual connections that they might be able to ask for the introduction. If they don't, my hack that I tell founders a lot is study up that investor, study Andrew's portfolio, what he's invested in over the last 6-12 months, and cold email a couple of the founders that he's put money into, and just, keep it real casual. Like, hey, I've been following Andrew on social media for a while. I know he invests in XYZ space. I see he invested in you. I'd love to just hop on a quick Zoom, chat about what it's like working with him, et cetera. And then if you build a little rapport with that founder, it's okay to ask for that intro to Andrew, right? Also just doing kind of tactical things like we've talked about this a little bit, but if you've built a pipeline of investors in Foundersuite or Excel, asking your advisors that you just gave some equity to come in and scan that list, and anyone they know, open up, mark themselves as the connector to that, like we talked about,
Yeah,
right?
that's my spreadsheet where I'm like, I
Yeah.
put myself down here. Like I can introduce somebody to John Frankel, and John and I go way back at FF, but maybe there's someone who's closer to John than me.
Yep.
And so you should kind of, coordinate that absolutely as much as possible.
And even if you've done all those three things, LinkedIn, ask your advisors and investors to scan your list, and kind of hustled through portfolio company founders, you're still probably going to have, whatever, 25% of people you have no connection path to. That's where I like this little tactic of reaching out to those folks, not pitching your deal right away, but really pitching like, hey, hey, Andrew, I see, you're investing in this space. I'm building a startup in this space. I'm not raising money right now, but can I have your permission? And I'd love your feedback on this. Can I have your permission to add you to our company update list? We send out a super short 1-page company update talking about what we're doing. It'll give you a little sneak peek about what I'm building here. Can I have your permission? So for the cold email, I like to do the permission email approach instead of like going for the pitch.
Yeah.
I don't know. Those are my thoughts.
I mean, I email is a problem for me. When Raul came into my office in San Francisco and pitched me his vision for Superhuman before he had founded the company or recruited the first employee, I was like, I'm in. If you can help me with my email and doing those things you're talking about, that is an enormous benefit to my life. It turns out to be one of the greatest investments we've ever made. But I was ready to fund it just because I needed it so badly. So when people ask me, hey, can I just put you on my monthly update list? I tend to be like, you know what? I'd rather not. I'd rather hear when you're getting close to 100K MRR, and that's within our first entry point sweet spot.
Yep.
Like,
so you'd rather be pitched, basically. You'd rather get the pitch direct rather than.
Yeah, but one thing I think can be very effective for a founder is to say, hey, I want to spend the next 2 months just pitching founders. I want so they actually reach out to other founders, and this is where it's great if you went to Y Combinator or Alchemist and you have an immediate set of brothers and sisters in your cohort or previous cohorts to alumni to go to. But if you can say, I want to pitch, literally 100 YC graduates in the next 2 months, and I just want feedback. So say, can I pitch you as an informational interview, practice, mock-up, exercise, VC pitch? So you pretend to be a venture capitalist or an angel, and I will not be pretending to be me. I'll be me. And so you say, and I swear to God, we'll do it in 30 minutes. So let's get on. Zoom has made it easy. Just get on Zoom. Let me pitch you. You give me feedback. And what may happen is that somebody in there has some money, might even say, you know what? I really like what you're doing and I can help you. So let me put in 25 grand. And so you have 25 grand comes in on a convertible note. Now you've got Vivek, founding CTO of Superhuman, is now one of your angels and he's in your deck. And if Vivek tells me this is a good deal, I'm like, damn, Vivek, when did you invest in that company? He's like, last week. You should meet them, but they're not going to pitch anybody for another 2 months. We're only pitching founders right now to get our act together. And then these should all be founders that, probably have raised capital themselves so that their opinions are interesting. And you may have gone and raised some money when you promised you weren't asking them for any money. You were just trying to do the pitch. And then of those 100 people, your spreadsheet should be filling in of who's going to introduce you. Now, Vivek will introduce you to Josh Kupelman at First Round Capital and introduce you to, whoever they were dealing with at IVP down the line, or Andreessen Horowitz, and they've raised money from all those people. So you can get a lot of warm intros by doing that. And just you you thought like, oh, I know everything about this, but with all these people on How I Raised It, your podcast, you've learned a lot. You learned a lot. You're going to learn a lot. You're going to learn a lot yourself in talking to these 100 founders,
Yep.
And that's one of the nice things of living in San Francisco is that, that's the reason you don't live there for the wonderful taxes, but that you can maybe meet a lot of people that, you could try that with. So what do you think
I love that. That's a great hack, so to speak. Yeah, I love it.
So let's talk about cold emails. I mean, we do invest in lots of companies that listen to a podcast and email us, but I like a good email, right?
Yeah.
Like there's some pretty bad, horrible emails, like especially the crypto guys. It's just horrific.
Oh, really? Are they?
But like, even subject, and what do you advise putting into a cold email?
I like to keep it really, really short. Here's my sort of format for this. Subject line, something like, I'll use my own, right? Intro to Foundersuite dash software for raising capital dash or hash, 3,000 monthly active customers, or FFVC leading the round, whatever, something intriguing and like exciting that might hopefully tease you into opening up the rest of the email, right? So something kind of who we are, what we're doing, and then some teaser, a metric, a growth metric, an investor. If one of those fellow founders actually did commit to putting in the round, Rahul of Superhuman leading the round, whatever it may be, or maybe you have a portion of the round committed. I see this with a lot of the angel list deals. They're all oversubscribed, right? That's always in the email. It's like 2x oversubscribed. Anyway, and that's, I think, getting a little tiring. But anyway, then the rest of the email is simply, hey, Andrew, this is Nathan. I'm building this SaaS platform for managing investor relations and fundraising. We've got 3,000 startups a month using this, plus a lot of investors and investment bankers. I'm raising a seed round to expand, to do XYZ, whatever that may be, to expand into venture world and take on maybe a competitor or something that you're already using, familiar with. And I'm raising $1 million. So I kind of talking about what I'm raising, and then I usually include a link to the deck, and the deck is hosted on Foundersuite, of course. And we kind of skipped over this, but the deck is very short. It's problem, solution, market, traction, team. So it's a 5-slide deck. It's a super short teaser deck, right? Problem, solution, market, traction, team, and then with a little call to action. Hey, I'd love to get some time in your calendar. Let me know when you're available if this is of interest, or here's my Calendly if you want to pick your own. And then that's it, basically. So it's what we're doing, what we're raising.
This is like a technical email, getting through spam filters. Do you think it's a mistake to attach a deck?
Yeah, this is a great question, because I know investors hate going, because they know I'm tracking you. When you go to my deck on Foundersuite, if I've turned on the view tracking, it's going to prompt you to enter your email.
Yeah, I mean, DocSend is, you can, who's looking at my deck?
Yeah. And I know investors hate that. I don't hate it.
I don't care.
So
I have nothing to hide.
I think investors have been trained by DocSend to accept this, that it's kind of the way it is. But I don't like attaching a deck, just because I just sent you this deck, and I've pitched 20 other founders who've given me great feedback. So I've updated my deck a lot, and it's a lot better now.
Yeah. Yeah.
So the online version I can update constantly. So it's always the latest and greatest. The attachment is outdated pretty quickly. So, but I know some investors don't like they want to see a PDF, right? So I like to do the link.
And by the way, I've got 2 people in my waiting room for my next Zoom, so we're gonna have to unfortunately wrap up. It was great catching up before I started recording with you, Nathan. But closing thoughts. I personally think on the email, I like to see in the text of the email, how suitable is this for what we do? Like, I want to know, like, quick, if this is like healthcare, life science, we don't do that. I'd like to see that right up front. I don't like to see they only mention revenue on some hard to see slide on slide number 47. Like I had to work that hard to find out if this is pre-revenue or if it's too late for us. Like we don't invest in companies with 100 million revenue unless they are our existing portfolio company. So it's like, is this in my wheelhouse or not? So I like to see like geography, what they do, what stage you're at. Like, are you in revenue or not? Don't make me work for that. Like sometimes I don't even open the attachment because I'm like, this email offends me. Like, like they're not respecting my time at all.
Yeah.
And they think I'm going to dig into slide 47 to figure out if it's pre-revenue or this is pure vision. They haven't quit their day jobs. So I kind of like to know kind of like stage, sector, geography. And like you said, if they already have a term sheet from John Frankel at FF, put that right up top,
Yeah.
So kind of get, use your 10 seconds to buy another 30 seconds to buy another 2 minutes.
Love it. Yep.
Kind of attitude.
Yep.
And with Foundersuite and all of your mastery from like when we met 15 years ago, the first time as being Mr. Fundraising Guy, have you guys raised money? I mean, we were competing with DocSend.
We did. It's funny. We did raise capital. We raised about $1 million, and then we haven't had to go back to the well since then. So we're actually a lightly funded startup that sells software for raising capital. Kind of ironic in some ways, but yeah.
That's awesome. I love a company where the liquidation stack is low. So if you sell your company for 50 million, you pay back 1 million, which is nothing, and you have a huge ownership percentage of the 49 as opposed to 18 years go away. I have an LP who invested in my fund who raised 130 million of funding, just like every VC you've ever heard of. And his ownership fell below 4%, went to 0. And he's like, we'll never sell the company for more than that. They're not giving him a carve out. And he left. It was like 18 years of his life. That's like, you should never quit your job at JP Morgan if that's what you got into. So anyway, I'm going to sign up. I'm going to start paying for Foundersuite myself. So tell us the URL of where to go so everyone can immediately start paying for this.
Yes. Well, thank you, sir. It's foundersuite.com, FOUNDERSUITE, foundersuite.com. And let me come up with a promo code. If you use code Roman, we'll do a 30% discount. How about that? Let me make sure.
Nice. Romans with an S. So,
Romans with an S. I'm sorry. Yes.
Okay. Email that to me and I'll put it in show notes when we publish it. That is totally dope. I'll use my own name to get my own discount and I'll start paying for it myself. All right, Nathan, great to see you. Look forward to seeing you in the real world.
Thank you. Bye.
Bye for now.